Hi there, ladies and gentlemen. It's James Marlay here, co-founder at Livewire Markets. And today we've got something a little different. We've got someone from Australian business and finance news royalty. I'm joined by Alan Kohler AM, who is the editor-in-chief at Investmark Group, but obviously someone that would have graced your television screen, no doubt, at some stage over the years. Alan, I reached out to you after a mutual reader suggested that it was time to have a catch-up. It's been more than 3 years since you were last on Livewire Markets, so appreciate you taking the time to have a chat with us today.
No worries, good to be here.
In preparation for our chat, I did a little a data snapshot on Australian markets, the economy, and the US. It seems like Australia's in the land of the threes, the cash rate at 3.6%, inflation around 3.2%, and it's hard to believe, but the ASX 200 is only up 3.15% for the year to date. So I thought maybe we'd just start with the Australian picture. Where do you see Australian rates and inflation heading as we move towards 2026? Because it's been maybe the sand in the cogs here in the Australian market.
Yeah, so I think the cash rate's likely to stay where it is for another 12 months. If anything, it goes up, probably not down. If anything, that'll depend on what happens to inflation. The economy's slowing down. I think that it's probably likely that the inflation rate will stay where it is or fall. So I do think that the cash rate won't go up. It'll probably just stay where it is for 12 months, and who knows what it'll do after that.
Yeah. So what's your take on the outlook for the ASX 200?
Look, I think we probably shouldn't get too greedy. I mean, yeah, it was 3 and a bit percent in capital gain for the ASX 200, but the accumulation gain, including dividends, is 6.5–7%. So that's okay. I mean, yeah, that's what you want, really. I mean, and that's year to date. So it's November. It could end up being, more than 7% for the year. We'll see what happens. But so look, I don't think it's terrible. Obviously, we're well underperforming, or have been underperforming the US, but really, you don't want that kind of ups and downs. I mean, the US. We'll get onto this presumably in detail in a moment, but the US is in an AI bubble, and so we don't want to be part of that. I was looking at some charts this morning of Australia versus the US during the 2000s bubble, and we didn't rise as much, obviously, but we didn't fall. We basically didn't fall at all during the course of 2000, 2001, or hardly at all, and our PE ratio really didn't change. So, I mean, whereas the US PE ratio, the S&P 500 price earnings ratio fell a lot. So the US repriced in 2000, 2001. We didn't really. And so I'm hoping that that's what happens now, although the problem, of course, is that the markets are a bit more global now than they were then, I think. So it's a bit hard to know the extent to which the Australian market will follow the US in whatever it does from here.
Just staying with the ASX, you've followed markets for decades now. In recent times, there's been quite a bit of commentary lamenting the composition, big banks, big miners being so dominant in the index. We've also seen small caps, and I would say this has happened even over my time in markets, is that it's been harder for them to get investor attention. These periods where we have concerns around the structure of the Australian market, have they come and gone during your career? Do you think that there's any substance to those concerns around the composition of the index?
Most of my career, the market, the Australian market, was dominated by mining companies, and that was really the whole thing. Big mining companies were what it was all about, and a few manufacturers. But really mining companies. And the big change is the rise of banks that's occurred in the last decade or two. And I think, now it's dominated by miners and banks, as you say, and that that's the way it is. I'm not, is that good or bad? It's just kind of the way it is. Yeah. Really, I mean, I think that the banks probably had become overpriced. They've corrected a bit, particularly CBA, and that probably has more to go. So I suppose it's probably the banks will end up being a smaller proportion of the market than they are now. But we've got a pretty solid, active biotech sector, and I think with CSL particularly leading the way, but there's a few others, ResMed and so on, Cochlear, have been good companies, and I think that there's a lot of smaller biotech businesses that are doing pretty well. Have got are on the threshold of doing some interesting things. So it's possible we'll end up with a more interesting and larger biotech sector in time. And the other one to watch, I guess, is critical minerals, which is going to be a big part of the future. It's part of the deal that's now been done between Australia and the US on a framework for critical minerals. And so some of those companies that mine that stuff might end up, although it'll take a while, but they might end up quite large.
Well, it's interesting to note that for the year-to-date performance across sectors, it's the material sector that's been the best performer for Australia. Obviously, with gold's been strong as well, but it's been healthcare and technology that have been the laggards this year. CSL obviously weighing on that.
Well, that's right. I mean, so it's a bit distorted, isn't it, by CSL, which and that kind of was a bit of a bubble in itself. CSL got too expensive, given the amount of growth, given the growth. I mean, CSL. The problem with CSL is that it was priced as a technology super growth stock, but in fact, it's a utility. And now it's starting to be priced as a utility, which is what it should be.
Why don't we turn to the US markets, because it's been impossible to ignore the rise of those top 7 stocks over in the US, but many others as well. You've expressed some caution suggesting AI is in a bubble. I listened to a few of your recent podcasts. Does that mean that's an area of the market that you're steering clear of? And maybe outline for our listeners a few of the views that underwrite that view that AI is in a bubble.
The interesting thing about this bubble, which I think it is that a lot of the prices, if not most of the prices of the stocks, are supported and justified by the earnings that those companies are making. And so it's arguably an earnings bubble as opposed to a price bubble. So the question is, can the earnings be sustained? And in particular, can the earnings justify or provide a return on the amount of capital investment that these companies are making? So what we're seeing is this colossal amount of CapEx that's going into preparation for what these companies believe is going to be a huge flow of earnings from AI, right? So they're all just spending colossal amounts of money on NVIDIA chips and data centers and so on, and they reckon they're going to make tons of money. And what I've been publishing on InvestSmart in recent times is some analysis of, how much do they have to make this capital expenditure pay? And the answer is, trillions of dollars of earnings, which are more or less impossible. And so what's going on now is the market is starting to realise that making the sort of returns that will be required is going to be very difficult. So now like last week we saw NVIDIA's results come out, quarterly results come out, and they beat expectations, big increase on quarterly earnings, quarterly sales, and the market celebrated at first and then went down because they realised that actually NVIDIA's customers that are giving NVIDIA all this money, they have to earn a return on their expenditure, and the question is, what's going to happen? How's that going to occur? So I think that's the problem. When's it going to lead to a correction? I have no idea. Nobody does. That's the problem.
People are still participating in, owning, some of these high growth companies. What's your view? Are you sort of a stand clear sort of person and let it play out, or are you, putting a toe in the water, a small allocation? How do you talk to your investors about what's going on in this AI, this AI part of the market?
I don't make direct recommendations. I'm not a broking analyst. I don't kind of say do this, do that. I mean, I just try to inform people as to what's going on and what I think's going on, and so on, as to how to play it. Everyone's going to have their own ideas. I wouldn't buy any AI companies at the moment. I think they're overpriced. So I'm certainly not in it myself, and I wouldn't suggest anyone do that. On the other hand, AI clearly is a a theme. It's happening. It is going to be a big business, a big industry. So, I mean, even though after the internet bubble crashed in 2000, we ended up with the internet, and a whole lot of companies made tons of money out of it eventually. So, and eventually Amazon was around then, and it kind of went down. And, if you owned it from sort of 95 onwards, you'd probably be doing great. I mean, I can't remember exactly when Amazon began, but certainly a lot of these companies ended up making tons of money. So look, probably the companies that are involved in the big 7, big 8 AI companies will probably end up making tons of money and be worth buying. You just need to have a very, very long-term view of it, and be prepared for some volatility along the way.
You have been around investing in markets for decades. I know you don't give individual and personal advice, but I suspect a lot of our readers are of a similar vintage to you and would be interested to know what you've learned about investing and how it's shaped the way that you invest. You've sort of talked about not dipping into those tech markets at the moment. Maybe you could just shed a little bit of light about how you think about investing and how you do it, given all the experience that you've got.
I certainly don't try to time the markets. I'm just not good enough at that. I just can't do it. I've learned, I did go through a period of investing in a few startups, and I've learned not to do that. That was very unsuccessful. So stay clear of startups. I suppose the way I invest is that I'll invest for the bulk of my money into ETFs and the market, broad index funds, particularly through the InvestSmart type of ETF portfolios. And then I've got a smaller proportion of the money in stocks in companies that I like, whether they're small or medium sized. I mean, companies that interest me and I like, that and I'm interested in following. So that's kind of how I do it. It's a sort of a barbell, as it were, approach with ETFs on one side and small to medium companies that I like on the other side. I don't tend to invest directly in blue chips.
Yeah.
I'll do it through ETFs.
Over your career, you've had a couple of business exits as well. You've been in media, and you've grown and started businesses as an entrepreneur and a journalist. I've started my own media business. I've got a few partners. I just thought, just as a bit of a reflection, any advice or any tips or any lessons you could share from your experience growing media businesses over the years?
Yeah, look, the one thing I'd say is that starting a business, growing a business is really hard. It's exciting and really good to do, but it's not easy. And and there's the beginning of it, but then there's the period that's often called the Valley of Death, where you are trying to convert the thing into a proper commercial business, and it's often difficult to get across that. I mean, I started the business in 2005. That was Eureka Report. Started Business Spectator in 2007, and we sold it 5 years later in 2012. So it wasn't what you'd call a long-term process, which I regretted a bit. I mean, I had shareholders. We got a takeout. We got an offer to buy the business. They said I didn't want to sell really, and they kind of said, no, you got to consider this, and we ended up selling. And I suppose it was a good price, so it was a good thing to do. But in the end, I mean, I really wanted this to be the rest of my life, running, being involved in a business. But that wasn't to be. I tried again, starting another business, this time with no shareholders, just me, using some of the money that I made selling the other one, and it didn't work. Really, I sort of got out of it by the skin of my teeth, but really it was not successful. So, what do I say about that? What did I learn? I learned that I suppose I learned not to be too ambitious. If you're starting a business, start really small. Make sure it's well funded and well capitalized. I didn't really have enough capital and I was too ambitious. I tried to do too much. The costs were too high. So yeah, that was. I mean, it would have been. I suppose it would have worked if I'd had fewer costs.
In terms of what you've seen during your career, positive innovations for investing, one thing that is true in markets is you're constantly seeing the product issuers trying to come to market with new solutions. We have seen low cost innovation. We've also seen asset classes that weren't previously available to many investors now being brought to the table. I'd say private credit is an example of that. What do you think are some of the positive innovations that you've witnessed and embraced during your career when it comes to people accessing markets?
Look, I think ETFs are a positive innovation. I mean, they're obviously fantastically popular. There's huge amount of money going into ETFs, and I think that's for good reason. I think they're great. So that's one thing. Another positive innovation has been what you might call non-conflicted financial advice, which, after the banning of trailing commissions for financial planners, I think, they've come up with different ways of operating, which works better. And so people now pay the right price for financial advice. Often feel like it's too expensive. You might end up having to pay $5,000 for a statement of advice, and I think that's probably too much. That there's too much work having to be put into the statement of advice to deal with the regulations around it. So I think that could be much less. But I do think a lot of financial advisors are working their way around that and are coming up with cheaper. I went to a financial advisor recently, and the session, the advice cost me $1,800, not $5,000. So, and I thought 1,800 is okay.
Yeah.
But and at least there weren't sort of. I mean, look, it is a bit hard. I got someone came up to me recently or approached me recently to ask for some advice. How do I find a financial advisor who doesn't want to manage my money? They wanted to end up managing it. They just needed somebody to set them up. And I was able to send them to somebody I know who will do that. But it is true that most financial advisors still want to manage your money, and they really are about that. I think we need more financial advice that is a bit, like going to the doctor, where you pay $100 or $200 for a session to tell you what you want to know, and then you go away again. So we could do with a bit more innovation there. But I think on the whole, financial advice and financial planning has come a long way, and it's much better than it used to be.
Any views on this, what's been going on in private credit? Because it has been on the front page of the newspapers, and ASIC's been all over it. These things are, a lot of them are available on the ASX, and there's been a lot of column inches dedicated towards the asset class. Is it something that you've spent much time looking at? Any thoughts on the private credit space?
Yeah, I've looked at it. I probably should write about this. I mean, the thing with private credit and private assets in general is that you're trading liquidity for return, and which is fine for a big investors, big super funds. Super funds started doing this a long time ago, putting money into private equity and then private credit. But the thing is that they were putting a small proportion, 5 to 10% of their money into these private assets, private equity and private credit. So they weren't really on the hook for a lot of problems with the lack of liquidity in any way. Super funds, long-term investors, they do have to have liquidity, but they can measure exactly how much liquidity they need. For private investors, small investors, you've really got to be careful about how much of your money you're locking up into something that's not tradable. Because the returns aren't necessarily that great. You've just got to be really careful that you can get locked in. So there's one property outfit that I've covered a bit, and people have been writing to me saying that they've invested in it and they can't get out now. and that'll be the case with a lot of private credit. I saw a TV ad the other day for something, I can't remember the name of it now, that's offering 7% 7% income returns, paid monthly, all this stuff. And it looks a bit like a bank on the ads, but you go onto the website and it's not a bank at all. Of course, what they're doing is they're lending money. They're a private investor. They're an investment manager, really. They're managing credit investments. It's not liquid. It's not liquid. It's not listed on the stock exchange. So look, my view is stick with stuff you can, get in and out of quickly.
Yeah.
If you want to put a small amount of your money into a private credit, fine. But really, the extra returns you're going to get from that are not really that much, particularly if you're putting only 10% of your funds, which is what it ought to be, into it. The overall effect on your portfolio is not going to be that great.
Final question, and you mentioned it. You like to back some companies that are interesting to you, and I note from having followed some of your interviews over the year, you enjoy speaking to the CEOs of listed companies and hearing what they're doing, how they're building their businesses, some of the opportunities that they're seeing. I just thought, and these are not necessarily companies you've invested in, but just companies that have impressed you. Are there any CEOs that might be flying under the radar a little bit? Companies that you've spoken to that show where innovation and good leadership's happening on the ASX?
Yeah, look, I did a series of interviews after the critical minerals deal between America and Australia. I did a series of interviews with some of the guys running those kind of companies, and I spoke to Daryl Katsubo, managing director of Arafura Rare Earths. He was terrific. Sam Riggle, who runs Sunrise Energy, he's got some scandium in the middle of New South Wales, and David Patterson runs Latrobe Magnesium. I didn't realise magnesium is hard to come by, and there aren't many deposits of that, and he's got some in Gippsland in Victoria. So these guys, all three of those guys have been plugging away for years. In some cases decades. So they're not sort of fly-by-nighters. They've been, they're quite serious. I really liked Sam Budaselic of Cash Converters. That was an interesting business that I spoke to. And the other one, I'm a customer of Aussie Broadband. They give me, I do my internet with them, and I spoke to Brian Mather, CEO of Aussie Broadband. That's a really well-run business. I like Brian, and so yeah. Look, I talk to a lot of CEOs, one a week at least, and try to make sure they're interesting companies. I like talking to small company CEOs because they're not media trained. You talk to a CEO of a big company, and they don't tell you a thing. Whereas if you talk to a CEO of a small company, they're frank and they're honest, and there's always an interesting backstory there that they've often been toiling away for years in the background trying to come up with trying to get this thing going, and finally they get there, and it's very gratifying for them. So it's good.
I was listening to your most recent podcast with Stephen Mayne, and it sounds like you've put in a few calls to the CEO of Drone Shield to try and get an understanding of what's going on. Is that you're going to put in a few more calls this week and see if you can uncover that one for us?
Yeah, of course. I've spoken to Oleg Vornik, the CEO of Drone Shield, I think 6 times. Once I've basically spoken to him once a year for 6 years because I thought it was such an interesting business. I never invested in it, which is to my regret in some ways. But obviously, it's been controversial because Oleg and a couple of other directors sold all of their incentive shares and haven't explained why, and the stock went down, and it was terrible. It's a real crisis for the company. They put out a very long statement this morning, Drone Shield, trying to explain everything, and Oleg is saying that he's still absolutely committed to the company and all this, which is fine. Good on him. So look, maybe it's a buy. I don't know.
Very good. Well, we'll look forward to that interview when you get round to doing it. Hopefully, there's a bit more of the story to tell. But Alan, just wanted to say thank you for taking the time to take my call and agree to an interview, and really appreciate you sharing some of your thoughts on what's going on in markets and some of the interesting things that are catching your eye.
Not at all. Thanks. I've enjoyed it, James. Thanks.